I'm Ryan, owner and founder of Kimberlite Financial Services. I want to talk about direct indexing. It is blowing up right now. Easily the number one question I get asked, and is also one of the most Googled financial topics. So, what is it? Actually, a lot of the explanations are far more complicated than they need to be. So, I made this video with a plain English explanation that shows you what it is, where the tax savings are, and whether or not it might be right for you. Be sure to watch the whole video because I think the numbers are going to surprise you. Let's dive in.
If you invest in the S&P 500, chances are you own it as a single fund. One ticker quietly holds 500 companies. Simple, low cost, and for most people, exactly right. But for larger taxable accounts, there's another way to own the same index. It's called direct indexing. Instead of one fund, your account holds the individual stocks that make up the index, hundreds of positions weighted to track it. Same exposure, same expected return. So why bother? Because owning the individual pieces unlocks something a fund can't: control over every tax law. Here's the key insight. Even in a year when the index goes up, individual stocks inside it dip along the way. Typically, 30 to 40% of stocks in an index show loss at some point during the year, even in strong markets. Inside a fund, these losses are locked away. You can't touch them. In a direct indexed account, you can. When a stock dips below what you paid, the platform sells it and captures the loss. That is tax loss harvesting. Then it immediately buys a similar, but not identical stock. Your index exposure never changes, but you have banked a real loss for tax purposes. And to stay clear of the IRS wash sale rule, it never buys the same stock back within 30 days. All of this runs automatically, every day. Those harvested losses are useful in three ways. They can offset capital gains anywhere in your taxable life: a rental sale, a business exit, a concentrated stock position. Up to $3,000 a year can offset ordinary income. And anything left over carries forward, indefinite. Let us make it concrete. Picture a $1 million taxable account, direct indexed to the S&P 500, in a year when the index rises 10%. Along the way, the platform harvests roughly $30,000 to $50,000 in losses while the account grows. Now suppose you sell a rental property with a $30,000 gain. The harvested losses wipe it out. At a 23.8% tax rate, that is about $7,140 saved from a portfolio that just tracked the index. Direct indexing is not for everyone. It tends to fit taxable accounts above $100,000 to $250,000, higher tax brackets, and investors with regular gains elsewhere. It does not fit retirement accounts. There's nothing to offset, or smaller accounts where fees outweigh the benefit. Two honest footnotes: direct indexing tracks the index. It's not designed to beat it. The benefit shows up after tax. And harvesting defers tax rather than erasing it. Paying later, or never, is exactly the point. Getting those details right is planning. Whether it fits your tax picture depends on the details. And that is a conversation. Kimberlite Financial Services can walk you through it. Book a call at Kimberlite Financial